Hello, and welcome to the latest edition of Citrus Bites. Before I start, I have two quick apologies to make. Firstly, Richard Harris couldn't be with us today. He's currently enjoying an early Christmas break, lucky him. And secondly, today's news may not have been the Christmas present that many of us were hoping for. So, the major news is that the Bank of England has decided to keep UK interest rates on hold at 4.75%. This was widely expected by the City, and the Monetary Policy Committee, the MPC, voted by a majority of 6-3 to leave the rate unchanged. Only a month ago, let's remember that analysts were widely predicting a cut, and that's following the two reductions that we'd already seen this year, most recently in November. In a nutshell, the reason for today's decision is inflation. So what's causing the issues? If you have a look at the graph that's up on the screen now, this shows the Consumer Prices Index, or CPI, and that it rose by 2.6% in November, and that's up from 2.3% in October. This is the highest level we've seen for 8 months, and in September it was down at 1.7%. And we have to remember that the bank's target is 2%. So what's caused this rise? Well, basically, it seems to be driven by increasing petrol and grocery costs, along with an increase in tobacco duty, which, if you remember, was increased back in the Chancellor's budget in October. We also have persistently high core inflation. Now, this is something that Richard mentions every time we look at these figures. It's something that he focuses on regularly. And if you remember, core inflation excludes volatile items like food and energy, but that figure also rose from 3.3% to 3.5%. So when you take those figures into account, you can see why the bank remains focused on trying to bring inflation back towards its 2% target. We also have a series of other issues that have to be taken into account. One is the recent budget from Rachel Reeves, which was a £40 billion tax raising budget. And clearly, there can be some inflationary pressures on the back of that. Plus, you have the geopolitical situation at the moment, which stems largely from Donald Trump being re-elected as President of the United States to take over in 2025. And obviously there are fears of trade wars around the world with talk of tariffs. So the MPC is clearly proceeding with caution. But this is very much a balancing act because the bank's also warning that Britain's economy at the moment is teetering on the edge of stagnation. They've forecast zero growth for the final quarter of 2024. Only last month, they were predicting growth of not mega growth, but still growth of 0.3%. But the uncertainties that we've talked about, plus evidence that companies are cutting jobs at the moment at the fastest rate since 2021, have prompted a downgrade in their forecasts. Usually you'd argue that signs of fragility like this are actually a good reason to reduce interest rates. But it's those inflation figures that are stopping them from doing so. Having said that, it's interesting that the MPC was divided in its decision. So you had 6 members who voted to keep rates as they were, and you had 3 members who were actually voting for a 0.25% cut, citing the worsening economic situation. The split highlights the challenges the bank's facing at the moment with its battle against inflation, but also the fact that it needs to prop up a struggling economy. Another thing that's complicating matters for the Bank of England is wage growth. Annual wage growth accelerated to 5.2% in October, making it harder for the bank to bring inflation down. So while higher wages help households manage rising costs, they also contribute to inflationary pressures. So what's next? Unfortunately, in the short term, more uncertainty in the mortgage market. Lenders are going to be reviewing their rates. You've also got the stamp duty changes that are coming in 2025. If you are looking to move home and you want to take advantage of those, as always, we would recommend that you speak to your mortgage broker. Andrew Bailey, the Governor of the Bank of England, has signalled that future rate cuts are expected, but he's also warned not to expect them to come too quickly. With so much uncertainty, including the geopolitical risks and the faltering jobs market, the banks opting for a gradual approach. Okay, that's all from me today. Thank you for watching, and we'll see you in the new year for more Citrus Bites, when Richard will be back presenting this far more professionally than I do. And until then, on behalf of everyone at Citrus Financial, I'd like to wish you a very Merry Christmas and a prosperous New Year. Thanks for watching. Goodbye.